Why is Bitcoin, once considered a risky experiment, now viewed as an unstoppable movement by Wall Street veterans? The answer might surprise you. Larry Lepard, a seasoned investment manager and author of The Big Print, joins the TFTC podcast to share insights from his decades of experience in traditional finance and his journey into Bitcoin. In today's discussion, we'll examine three central points about Bitcoin's evolution: its transformation from experimental tech to proven monetary network, the significant reduction in systemic risks through institutional adoption, and why the current risk-reward ratio remains compelling even at higher prices. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. What Larry reveals in our final segment about Bitcoin's network effects and adoption metrics shows why this shift is irreversible. But first, let's explore how Bitcoin evolved from a risky experiment to a legitimate monetary movement.
The speed at which it happens, to me, that's a very uncertain thing. I mean, it could take a long time to get to 1 million, or we could be at 1 million in a year. I just don't know.
Yeah.
And by long time, I mean 5 years. I think within a 5-year window, these are $1 million a coin easily. I remember talking to people about it, and frankly, I was concerned about it, that the government was going to outlaw it, ban it, tax it, attack it, etc. And then the ETF got approved, and suddenly that was no longer such a big issue. So, it's clearly starting to, go mainstream, as we all can see. And, Saylor talks about, we're in the, really in the 10-year kind of gold rush period where it's going to, I think, just explode into everybody's consciousness. I mean, when it gets to 200 and 300 and 400, people are going to be wondering, hang on a second, what is going on here?
Yeah.
This isn't a bubble. I mean, this is a movement. And if that's matched with the price of everything else is going up really rapidly, then we could end up seeing, a large-scale adaptation of Gresham's law, where, people realize, oh my God, I got to get out of this burning fiat money and into something sound.
Bitcoin's transformation from an experimental technology to a proven monetary movement is vividly illustrated in Larry's perspective. Back in 2013, when I first encountered Bitcoin, the concerns he mentions about government intervention and potential shutdown were widespread and legitimate. The landscape was filled with uncertainty. Would regulations crush it? Would governments ban it? These weren't just hypothetical fears. They were real barriers to adoption that kept many potential investors and institutions at bay. But what we've witnessed over the past decade has been nothing short of remarkable. Bitcoin hasn't just survived these challenges, it has systematically overcome them. The recent approval of spot Bitcoin ETFs represents more than just another financial product. It's a watershed moment that validates Bitcoin's legitimacy within the traditional financial system. This evolution demonstrates how Bitcoin has successfully navigated the path from a speculative experiment to a recognized monetary movement. Larry's emphasis on the transformation of risk perception is particularly insightful. Early adopters had to contend with fundamental questions about Bitcoin's survival. The network faced technical risks, regulatory uncertainties, and the very real possibility of fading into obscurity like previous digital currency attempts. But with each passing year, each test of the network, and each institutional milestone, these existential risks have diminished substantially. This isn't just about price appreciation, it's about the fundamental strengthening of Bitcoin's position in the global financial system. We've seen how Bitcoin evolved from an experiment to a movement, but the story of institutional adoption reveals an even more compelling transformation. The way traditional financial giants are approaching Bitcoin today shows just how far we've come, and you won't want to miss how this ties into our final revelation about Bitcoin's unstoppable network effects.
It really is true. Yeah. I always kind of sensed Dalio would get it, because Dalio had been a gold guy, he'd been a sound money guy. I think he just didn't understand the technology. Look, guys like Paul Tudor Jones, they got it instantly. I mean, he says the fastest horse. I think Druckenmiller gets it, but he kind of admits that he's just not up on the technology, and so he's not comfortable being in it. I think, although I bet he holds a little bit of it. Look, everybody gets there eventually. I mean, I remember talking to Max years and years ago, and I was kind of there, but not all the way there. I still believed in gold. And he said, gosh, it sounds like you're kind of orange-pilled, but not all the way. And I said, that's about right. I mean, I get it, but I'm it's a little bit of a show me. And I think everybody's Bitcoin journey, some people are different. Some people just get it totally and go 100% right away. I think most people have been in the investment business for a while. It takes them a while to fully kind of grok it and go down the curve, get all their objections answered, and then maybe live through a few cycles and see that, hey, you know what, this is kind of working, and what I'm hard pressed to figure out what stops it. I mean, when people say this is going to blow up or it's a Ponzi, I say, why?
The institutional adoption story Larry describes marks a crucial phase in Bitcoin's maturation and risk reduction. Consider the significance of names like Ray Dalio, Paul Tudor Jones, and Stanley Druckenmiller. These aren't just any investors. They're some of the most successful and respected figures in financial history. Their journey to understanding and accepting Bitcoin mirrors the broader transformation occurring within traditional finance. What's particularly significant is how each of these institutional investors approach Bitcoin from different angles. Some, like Paul Tudor Jones, quickly recognized its potential as a hedge against monetary inflation. Others, like Ray Dalio, took a more measured approach, viewing it initially through the lens of traditional gold investing. This diversity of approaches actually strengthens Bitcoin's position. It demonstrates that multiple paths of analysis lead to the same conclusion about Bitcoin's value proposition. Sup, freaks? This rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. The gradual nature of institutional adoption that Larry describes is actually a powerful indicator of Bitcoin's reduced systemic risk. Rather than a sudden rush of speculative interest, we're seeing a methodical, thoughtful integration of Bitcoin into institutional portfolios. This measured approach suggests that these investors are building long-term positions based on fundamental understanding rather than short-term speculation. It's this kind of adoption that helps transform Bitcoin from a speculative asset into a legitimate institutional investment. We've now seen how Bitcoin evolved from an experiment to a movement and how institutional adoption has significantly reduced systemic risks. But the most compelling evidence for Bitcoin's transformation comes in our final segment, where Larry reveals why the current risk-reward proposition is more attractive than ever, even at higher prices.
The only ways it fails, in my view, are massive technical failure. I think we're beyond that statistically in terms of the number of blocks and time it's run. The other is if everybody loses interest. If suddenly, I've often said, money really is a collective illusion. Money is just what we all agree to be money. And that was Menger's great point. Carl Menger, the founder of Austrian School of Economics. And so, if suddenly we all decide, this stuff's just not so great, I don't care about it anymore. Let's, something else is better. Let's go somewhere. Well, that would be an issue. But that's not really what we've seen happen. The adoption, wallets, hash, whatever metric you want to use, they're all growing solidly, continually. Use cases, etc. So I don't perceive there to be that much risk of this not happening. I think there are a lot of different paths.
Larry's breakdown of Bitcoin's current risk factors presents a fascinating evolution in how we evaluate Bitcoin's position in the financial landscape. His analysis centers on two primary risks, technical failure and loss of collective interest, and demonstrates why these concerns have become increasingly remote as the network has matured. At 1031, we see similar patterns when evaluating investments in Bitcoin companies. The fundamental risks that once dominated discussions have shifted dramatically. The technical risk aspect is particularly telling. After more than 15 years of continuous operation and trillions of dollars in transactions, Bitcoin's core protocol has demonstrated unprecedented resilience. Think about this in practical terms. Bitcoin's network has been running nonstop since 2009, processing transactions 24/7, withstanding countless attempted attacks, and maintaining perfect uptime. This track record isn't just impressive, it's unmatched in the history of digital systems. What makes Larry's analysis especially compelling is his discussion of money as a collective agreement. This perspective is crucial for understanding Bitcoin's current risk-reward proposition. When he references Menger's insights about the nature of money, he's touching on a fundamental truth. Money works because we collectively agree it works. What we're witnessing with Bitcoin is the organic growth of this collective agreement on a global scale. The continuous increase in adoption metrics, whether it's wallet addresses, transaction volumes, or mining hash rate, all point to strengthening rather than weakening network effects. This growing network effect directly addresses the second risk factor, the possibility of people losing interest. The data tells a clear story. Each metric of engagement with the Bitcoin network has shown consistent growth over time, even during bear markets. This demonstrates that Bitcoin's utility and adoption are driven by fundamental factors rather than just price speculation. When you combine this with the reduced technical risks and increased institutional adoption we discussed earlier, It's clear why the risk-reward proposition for Bitcoin remains compelling even at higher prices. The network has moved far beyond its experimental phase, systematically addressed its major risk factors, and continues to demonstrate growing utility and adoption. Looking at the convergence of all these factors, the evolution from experiment to movement, the institutional adoption reducing systemic risks, and the strengthening network effects, we can see why Larry's thesis about Bitcoin's risk-reward profile makes so much sense. The risks haven't just diminished. They've been systematically addressed and overcome, while the potential rewards have only grown with increased adoption and utility. Will Bitcoin's evolution from experiment to Wall Street favorite continue? Let me know in the comments. I read every single one. And if you found this risk analysis interesting, you'll want to watch our breakdown of Bitcoin's path through monetary collapse. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.